I live in an apartment in Bangalore and there is this young, dynamic person whom I know. He got placed in 2019 in an IT firm and saved a good sum of money before the market came crashing in March 2020. He very smartly invested all those savings into the equity market. Whenever I met him casually during our walks or somewhere in the clubhouse, he came across as a person who's very knowledgeable, did a lot of research before investing his sums into the equity markets. But when I met him about a week or two back, he was not his usual self. He looked worried and I asked him what happened. He said, Anand, I had actually allocated a large sum of my money in this sector which got beaten up both in India and the US. What should I do now? I said, you should sell it off, provided you fall under these 4 conditions. He said, which conditions? Let me tell you about those 4 important reasons why you should sell your equity now, even though it means lower profits or loss. Please watch the video till the end. So I asked him, do you know what is asset allocation? He said, yeah. It means splitting your money between various assets, equity, debt, commodity, currency, and real estate. I said, wow, that's great. Do you know what your asset allocation should be? He said, yeah, it should be about 80-20. I said, wonderful, you know a lot of things about asset allocation, but did you practice asset allocation in the last 2-3 years? To which he said, maybe not, because I was so busy looking at the equity market returns that I actually forgot about debt markets. Moreover, why should I be bothered about debt markets, which was giving me about 4-5%? I said, that's the very same reason why you should sell your equities today. See, everyone believes in a certain risk profile or believes that they have a certain risk appetite, right? For you, it may be 80-20. For someone, it may be 70-30, 70% being in equity and 30% being in debt. But during this market run, it ended up becoming 90-10, 90% equity and 10% debt, which means a danger sign for you because your risk profile is today not matching with your allocations. Now that the asset allocation is all over the place, what you should do is take this opportunity, though it means exiting equity at lower levels, to rebalance your portfolio in such a way that tomorrow, if there is a bigger crash, you can shift more money into equity, and then tomorrow, if there is a bigger equity rally, you could shift more money into debt. It's as simple as that. This keeps you sane during market falls and also during market crashes. Hey, I said, now let me ask you another question. What was the objective behind you investing this money in 2020? Did you have a certain plan for this money? Did you have a certain duration for this money? I said, yeah, I wanted this money in about 2-3 years to pay off my education loan. I said, first of all, investing in equity for 2-3 years itself is risky. But nevertheless, now that you've earned your money out of it, why didn't you actually think of exiting? To which he said, I thought the markets are anyways going up and I thought I became a little bit of an expert and I understand the market. So I let the profits run. I said, wonderful, now that you've done it, but you should understand that the objective of this money was very different. You had a short-term or a medium-term goal clearly planned for it. And plus, this was the money that you had to pay off as loan, which itself is risky in my opinion. But congratulations, now that it is paid off, you should exit your equity portfolio and pay off those short-term objectives for which you had set aside the money. Did you get my point? Now let me ask you a third question. You know, investing is a lot more psychological than just logical and arithmetic. He said, no, I don't know. I thought it's all about company's growth. Of course, at the end of the day, companies' returns are going to be dependent on the earnings it produces. But that takes a long time to pay off. But then there are a lot of psychological factors that you need to go through. Do you know that markets can correct by 10, 15, 20, 30, 40, 50%? Yes, 50% also. He said, I never thought it would fall by 50%. To which I said, I have seen it twice in my lifetime. Now that you're panicking at a 10% fall, just imagine what will happen if there is a 20-30% fall. To which he said, I can't even imagine that situation. And that's a very same reason why you should tune your mind. And if you're not tuned for big losses, you should exit or continuously exit your equity portfolio as and when you feel or start feeling uncomfortable about market falls. The fourth reason may not be really important for him, but for a lot of other people who are watching this video, this is more suitable for people who are nearing retirement. Now that we have all seen markets, especially people who are 50, 55, who have seen the market going down and coming back, even after seeing 2000, 2008 crashes, people now think that eventually markets will come up. So why should I really bother changing my risk tolerance? Let your market be in equity, even though I am 60. Of course, equity will pay off, but then it always makes sense when there is a withdrawal to keep a good portion of your money in debt so that you are not dependent on equity market short-term moves for your survival for the next 2, 3, 5 years or so. Just imagine you're reaching 60 and you want to have regular income in your portfolio, and just when that was to happen, the market crashes. What would you do for your money? You don't have a reserve fund created yet, right? So that's the reason why, as you're closing retirement, you should start de-risking your portfolio slowly. Psychologically, again, it's very difficult for an investor who has made a lot of money to de-risk his portfolio as he grows on to retirement. But yes, you should do it. See, money, again, as I said, as I mentioned earlier, is a lot more psychological than just being logical about it. If you're not able to go through these short-term falls, medium-term falls in the market, I believe you should hire an advisor or an investment manager who should and will help you manage your portfolio a lot better, both arithmetically or logically and psychologically. How did you like this video? Please let me know. Good luck.